You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Right along with our next panel, which is Volatility on the Ballot, sponsored graciously by Bank of America Securities. This is sure to be a nuanced discussion of the dynamics of our marketplace this year. To help me introduce your moderator and panelists, please welcome to the stage Steve Nijom, Director of Electronic Sales for Bank of America Securities.
Thank you. As you mentioned, my name is Steve Jimon, your proud sponsor for the next panel. I'm with Bank of America's electronic trading on the sales team. Here to introduce the next panel to deal with market volatility during an election here. Ellen Greene will be moderating the panel. Without further ado, introducing the panels to come to stage. Thank you.
Good morning. It's nice to see everyone here. We get lots of jokes if you're moderating or if you're on a panel the last day about how crowded the room might be, so it's good to see here. And I do want to start just by thanking OIC. Tricia and Jen have just done a phenomenal job with the conference this year, and And it's wonderful to participate. I'm sure we're all wondering where next year's conference will be, which we'll learn after the last conference today. But why don't we begin, and I'll introduce our panelists. Actually, I'll let them introduce themselves. I'm Ellen Greene, Managing Director of Equity and Options Market Structure at SIFMA.
Good morning. I'm Dennis Davitt, the CIO for Millbank, Dartmoor, Portsmouth, which is based here in Asheville, North Carolina. So I'd like to thank everybody for coming down.
Good morning, everybody. I'm Geoff Gaiss. I work for TRAFiX, and I look after all of our derivatives customers in the United States, Europe, Canada.
Hi, I'm Jim Toes. I'm with the Security Traders Association.
Wonderful. Thank you. So as we look ahead to November, many folks continue to speculate about the outcome of the presidential election. There's certainly lots of focus on on Congress and their ability to legislate, something that I think we'd all agree has been pretty much largely stalled during this current term. But as we look forward to the next presidential election, what impact will this have on the markets? And do you think the next president, whether it's Biden or Trump, will have a better ability to legislate than we've seen in recent years? Do you want to kick it off, Dennis?
Sure. One thing that stands out to me is in 2016, when Donald Trump got elected president, 49 to 51% of the country said it was the end of the country as we know it. The uncertainty would drive markets lower. And next 4 years, we saw markets rally. 2020, Joe Biden got elected. The other 49 to 51% of the country said this is the end of the country as we know it. It's going to be a communist state, and markets are going to plummet, and markets continue to rally. So I think the only thing we can agree on in whole as a country is that the election has little to nothing to do with what we were 100% wrong over the last two elections, both sides predicting the end of the world. I mean, elections matter. They do have impacts. And who gets put on committees and a lot of stuff that's been talked about so far, be it Bitcoin, be it carried interest, be it 60-40 tax treatment on SPX, could all be in play in the next election.
For sure. And I think, too, that if we're going to talk about it, too, we should think about what returns have been, with the S&P 500 from we have a sample of 24 presidencies or 24 administrations. And within that period, I think what we find is that elections and their outcomes, like Dennis said, really don't have a bearing on medium to long-term returns for S&P 500. 20 of those 24 periods, we saw that the markets were up, just under 10% on average. We were only down in 4 of those periods, and it was during times when we would all suspect, during the Depression, and then later it was in 2000 when there was a contested election result, and then 2008, obviously during the financial crisis. So I think segueing back to the contested election in 2000, when we speak with our customers, and traders, I think that theme comes up pretty routinely. That I think that could be the single biggest factor risk as we go into this election could be, that one of the greatest features of our democracy is that when somebody gets voted out, they leave. They leave the office. But whether that's Trump or Biden that get elected, there's a good chance that one of those candidates is going to contest it. So that could definitely introduce some short-term volatility and lift vol up in the short end of the curve.
So I'm going to agree and disagree with some of the comments that just were made. So I do think, one, that it is going to be somewhat of a muted response for the reasons that we just stated. Plus, this is a unique situation in that we know what we've lived under a presidency of Trump and the presidency of Biden, and that's kind of like unusual. We've never had that happen before, right? Where both candidates have been presidents. So we should, if the one who's if Biden gets voted out, the new person coming in isn't new anymore. I think we all know what to expect, and as far as what executive orders get done. I do think that listen, there is a chance that we get all 3 branches flipped in this election. We could, and I think that has a different outcome to it. Listen, this is a very unproductive Congress, no matter by any measure. The amount of bills that have been passed is the lowest of all time. It's a one vote majority, and it seems like the extremes, the 15% wackies on both sides, seems to be going from 5% to 10% and growing. So I do think that this election is going to have some knock-on or ramifications on it, but I think as far as the markets go, I do agree. Like, I think it's the worst thing that we hate is that we're not knowing, right? But we do know. We do know what a Trump administration will look like, and we do know what a Biden administration will look like, and the markets will adjust accordingly. The last thing I'll say, though, is that the hard part here too is a decade ago it was such an easy thing. Like, if a Republican wins, go out and buy defense stocks, and if a Democrat wins, buy pharmaceuticals or healthcare. This uniparty that you hear about, it is kind of true. It's like, can we possibly spend any more money on defense than we did the past 2 years? It's like, no, it's impossible. So I do think that some of the industries, like the touched on here, Bitcoin and other areas, maybe there are some nuance here, but for the most part, probably a muted response. And then probably the only wild card here is really the taxes. The Trump tax cuts expire. That's going to be a big conversation next year. Real boring stuff. I will not come up on the stage to talk about tax policy if invited to come back next year.
Thanks, Jim. And it definitely is unique that, to the point you made, regardless of who wins the election, we know what to expect with it because they've previously been in office. Continuing with the election theme, certainly there are a number of issues impacting all of us in the room, things that voters will be thinking about, including inflation, immigration, health care. Curious if you folks agree that these are some of the key topics. And, Jim, why don't I start with you? And we'll deviate a little because it's kind of a unique situation that Jim is in. Jim and I both live in the 3rd Congressional District of New York, which some of you may recall was George Santos's district. Republicans put forth Mazie Pilip in the primary. She did not do well versus Tom Suozzi, who had previously been the congressman in the district. And, when we sat and had our prep call, Jim was still actively running for Congress. But it's probably worth just taking a couple minutes for Jim to explain to us what's happened with the Republican Party and how it's impacted his ability, as well as 3 other candidates, to be on the primary ballot upcoming in June. So Jim, I'll turn it over.
Yeah, I'll be really quick. So, so I'm now officially a former congressional candidate. So, the primary election is supposed to happen on June 25th. There were 5 candidates that were in the mix on it. One of them was the party nominee. The party nominee challenged the petitions. You had to file a petition with signatures to get on the ballot. The party nominee challenged the petitions of the 4 rival candidates, and he was able to knock us all down under the 1250 mark. So he will now be running unopposed June 25th. We can have a separate panel on that later, but as far as like the issues that were impacting our district is very similar, I think, to what is really going on, across the country here. I mean, I'll skip most of the ones, but I think it's just it's this cost of living, that is impacting all of us. And it's like this trifecta of causes. It's like a trifecta, meaning that there's problems at the national level, the state level, and the local level that is just causing this increase affordability of living, no matter where you are on it, whether it's energy, food, and now these like money grab gotcha type fees, that drive me crazy. I got to tell you, that's where the revolution is going to start. They're going to hit us with one more gotcha fee, like started out with like red light cameras, and now we got speeding, now we got congestion pricing. We're just one more gotcha money grab fee away from revolutions kind of perking up around the country here. But the cost of living is a problem. It is, and it's being impacted by policies at both the national, the state, and the local levels. And people are voting with their feet. They're moving out of cities and they're going to other places where the cost of living is cheaper. And that's a good thing that we have that competition among the states.
Jim, Dennis, thinking about the seat that you're in and, the issues that are facing all Americans now, what type of impact does this have on options trading? And as a result of some of these issues, have you seen emergence of any new trading strategies?
Yeah, so I've had 3 careers. I was a floor trader in the SPX bit, and I was a bank trader at Credit Suisse, and now I'm an asset manager. And as an asset manager job, one of the things I go out and I ask people, like, what's in their portfolio that they hate? I used to ask them what they love, but they all wanted rainbows and unicorns for free. So in the head, say there's no such thing as rainbows and unicorns. And anyway, it's not a good way to ask somebody for money. So when I ask people what they hate and really what they're fearing, and then try to craft a derivative solution to that problem. That's like, in a nutshell, the nature of my business. And I've always been very vocal of anti-tail risk funds, because I felt like they usually are structured on whatever the last tail risk event was. And by definition, a tail risk event is something that you don't know what it's going to be, or you could have hedged it. I've come to listen to what their concerns are now, and the biggest concern that no one's really talking about is the debt. I mean, people are talking about it for talking points, but this is the first time I've had large pension funds, endowments say, with the higher interest rates, we're driven to LDI, which is liability-driven investing, so they're now fully funded because they can invest in bonds at 6%, where they had very little bond exposure because it only paid 1%. They couldn't meet their bogey. So they've amassed this rather large treasury positions. People would walk around and say, who's buying all these treasury bills when they were at 3 and 4%? It was the pension funds and endowments. It was a great opportunity for them. The tail risk event that I'm now looking at and pricing for people is a separation between credit and rates. And I know that kind of sounds funky, but you look at HYG or JNK, and those are trades that are much more credit-based. Will the bond get paid, right? That dictates the value of that bond. Where rates are, well, this is where the government sets the rate, and if the rate moves, well, we adjust for that rate. What happens if the creditworthiness of the United States goes away and it dislocates? So that's what I'm saying, the merger of credit and rates. That sort of separation is highly unlikely. I was telling somebody about it yesterday. They rolled their eyes like, that'll never, what? No way. But that's a tail risk event. So, I always quiz people and say, how much has the United States spent on the space program from Alan Shepard to Elon Musk? And, get varying answers. The answer is about $500 billion. And I said, we spent 10 times that, $5 trillion in 18 months under COVID. So any expert that's out there is not an expert. Anyone who compares inflation now to the 70s is a fool. Like if you come to small towns like Asheville, North Carolina, you can see the impact of that COVID money and why inflation still exists. If you live in New York or Chicago, you don't see it because it's not as impactful. So the trades I'm seeing now and I'm pricing up are more tail risky type things, oddly enough, in fixed income. I said, why do you want me to do a fixed income tail hedge? I don't like tail hedges, and I don't trade fixed income. And they say that's precisely the reason we want you to trade it, to model it, because you're not going to peddle something to us that's overly complex and may not work with counterparty risk. So, I mean, if there's one thing you're going to pull, I don't want to go into, I think real estate vol is cheap versus S&P, and that's a vol arb. But if there's like one thing you take out of this that I've seen, are people are seriously worried, the people who allocate money are seriously worried about rates in the US, where you could see SOFR go from 5% to 7% over 3 days. How does that affect my portfolio? You know, a little different from Silicon Valley Bank, but that's sort of assumed we don't have to worry about that risk, and then it rears its head. I don't know, monopoly.
So interesting. So focusing on credit, and you know, Geoff, if we think about the S&P 500, that's clearly a really key barometer of the markets, how the economy is doing. And as we do think about that, earlier you had mentioned carried interest, and there are other favorable treatments that people are receiving now, which we think has helped, you know, contribute to a stronger economy. Can you expand upon the carried interest, which is taxed at a capital gains rate as opposed to ordinary income? And how do you think about this looking ahead to the election?
Sure. Well, similar to Dennis, I've had a few lives in the industry as well. So currently working at TRAFiX, which is a broker-neutral trading platform where we focus on the underlying technology that our customers use to trade equities, options, and other asset classes. Prior to that, I was a derivatives trader for over 15 years, both buy and sell side capacities. So, you know, over that time, I remember, you know, you would try to go to customers and you would pitch them ideas that you're trying to do, you know, put spreads and, you know, protective type strategies on portfolios. You know, you're buying that 25 delta put, selling that 10 delta put against it, and, you know, trying to get 4.5 or 5 to 1 type of leverage or payout on that type of protective structure. And what ended up happening over the years, and I saw this happen, was there was a deterioration in demand overall for those types of strategies. And you know, now, similar to what Dennis said, I think that what you're finding is now there's a bit of a return to that, right? Where now people are worried about kind of, you know, you mentioned uncertainty, right? That's one thing that the markets hate, and S&P 500 is a barometer for the economy, and we would always say on the desk that it really is a voting mechanism. You know, when folks go and purchase S&P 500 and its constituents, you're voting yes for the United States and for the economy at large. And, you know, I think we talked about immigration, we talked about healthcare being big issues for this election. You know, I think really what the most important one is thematically talking with customers is where we are currently in the investing cycle. You know, I think there's a lot of concern around that. We talked about credit with J&K and HYG and those products, and, you know, we see some of our customers transacting in those, you know, particularly to try to hedge, you know, specific factor in credit risk. But, you know, let's look at where we're at in the cycle. And we have, you know, long-term, you know, credit rates are starting to ratchet higher. And then we see, too, in S&P 500 where the concentration is with Magnificent Seven stocks, right? So you have 7 stocks that are responsible for somewhere around 28% of the overall, you know, market cap composition of S&P 500. And, you know, last year we saw S&P 500 was up some 25% year to date. And if we look at the Mag 7 as a collective group, Apple was actually the slacker of the group, and it was up 50%, right? It was bookended on the other side by NVIDIA that was up some 248% or something along those lines. So, you know, I think too, as we come back to this election, and if we do see any volatility in the short or medium term, to attribute it to the candidates, I think would be unfair, because I think maybe where we're at is just kind of at a point of peak valuation, or maybe the market's just become exhausted up here. You know, we've enjoyed such an incredible run in terms of these higher beta, you know, growthier tech names that have been leading the way. And kind of to segue back to your question about carried interest, I think that that's probably going to be something that, it's a controversial topic, right? It's a bit of a third rail for private equity funds and for hedge fund managers. Is it going to affect their decision-making process? It might. It might affect their decision-making process, because if taxation is going to increase from that 20% capital gains rate to the ordinary income of around 37 to 40%, somewhere in that range, you could see maybe they're going to push into more, riskier investments and things like that to try to augment or amplify gains. So it'll be interesting to see how that plays out.
As we've sat here talking at the conference for the past few days, I think one of the things that we all recognize and benefit from is that our U.S. markets are the most deep and liquid in the world, probably the envy of the world. But for many of us, there's been an acute focus of regulatory agencies right now. There's been a barrage of proposals that we've seen come out of the SEC under Chair Gensler. Many of the final rules that he's approved have been followed by litigation. So clearly the chair is looking to make his mark on the markets. I think a lot of us would agree that some of the things he's putting forward perhaps don't need to be put forward. Our markets work well. Having a focus in equities as well. We spend a lot of time looking at the 5 equity market structure proposals, some of which would impact options markets as well. But, certainly the chair has his agenda. He's looking forward to putting new rules forward. And, as we think about this, Jim, can you share some of your views on how these proposed regulations could potentially be impacted by either a Democrat or Republican coming into the White House?
Well, I mean, trying to just turn that to the topic of volatility on it. I mean, we talked about how uncertainty impacts volatility. Nothing will impact volatility more than operational performance of the marketplace. That the fact that God forbid, wherever the markets don't open at 9:30 or some type of systemic outage that prevents stocks from being traded. And so, I'm probably the only one here that was on a trading floor in 1987 when the market did crash and things broke, things absolutely broke, and that was really bad. And our markets, knock wood, really haven't had an experience like that. We've withstood the COVID, we've withstood the financial crisis. You may not have liked the prices that you got on your sales, but at least you were able to get your orders traded done. So I think that the number one responsibility, obviously, of a regulator is their number one responsibility is to do no harm and not to be making something more complex and putting some type of potential of a systemic outage that could happen here. So, as far as what we're seeing, we as an industry, what we're seeing in financial services, we have the head of the government agency that the SEC was responsible for oversight of our industry. Obviously, he's an unelected official. He doesn't really appear to have a lot of respect for the Administrative Procedures Act, APA, as far as rulemaking goes. It appears that he's, some of his actions are more around the political agenda of the person who put him in the seat. Like what we're seeing in our industry, it's going on across multiple industries. Okay, it's not just us. It's at other EPA and other government, all those other 3-letter agencies that are going around, and that does have a cost to it. And listen, and by the way, as a general statement, we do believe that we like competition and we like good regulation. You can't, and we do think that good regulation does have a role, a very positive role to play in the growth of our markets. The safety, the fact that investor protections are there. Around it makes people feel safe. It feels like they have a recourse in case they're not happy with maybe they were aggrieved in some situation. They have recourse and that there's someone looking out for them. But too much of anything kind of like that balance between competition, because there's a lot of benefits with competition, man. Competition, you have choice. Choice builds resiliency in the marketplace. Investors have a choice where they can go with their money and if there's a good competition, if there's reasonable barriers to entry on it, but there's also a role for regulation as well. And we just feel like that barbell, which kind of should be equal, is kind of going way heavy on the regulatory side here. So I think the concern we have around it is that, You've heard it all for the past couple of days, too much, too fast on some of these things. Our markets, as Alan mentioned, they are the deepest in the world. They are the greatest. If we wanted to talk about fast trains, we'd be talking about, Japan and Switzerland. But if you want to talk about capital markets, this is the best marketplace in the world. Why are we going through this whole complete overhaul and fix of the equity marketplace? I don't understand.
Yeah, it's pretty incredible because it seems, when you look at some of these proposals, they actually look like, perhaps the chair doesn't want any of us as individual investors trading and making decisions because, when you look at the rules in totality, the impacts of them would really, really be, dramatic on how we do interact with the markets.
Yeah.
So Dennis, you run a $500 million asset management firm. Can you share with us your views on how regulation impacting the capital markets, including public issuers, market participants, and especially smaller firms? Certainly a lot of these regulations, as I think all of you know, are really driving up the cost of doing business. And how does that impact somebody who, runs a firm, whether you have 2 people or 200 people? Does that make your job much more difficult?
Yeah, I mean, when you run a small firm, you wear many hats, right? And as the firm gets bigger, you start handing out hats. To touch on what was said about U.S. markets, one thing I just want to talk real quickly before I talk about regulation is the depth of the U.S. market. It is fantastic. And I remember, the story of working at Credit Suisse, going from the floor to Credit Suisse, and there would always be somebody who would come over from either Hong Kong or Australia or France or England, and they would always think they were the biggest guy on the block, and they would put up a trade, and then they would just get stuffed on the trade, and then they would buy more, and they get stuffed again, and then it would come back, it was offered even lower. And it was always interesting watching these people mature. These are highly sophisticated traders, but just the depth and the singularity of focus on the U.S. markets is unmatched in the world. I can always see people go from Australia to Europe to Hong Kong, even India. The U.S. is unique in its approach, and I don't think people realize that how unique U.S. markets are unless you participate in other markets around the world. And the other thing is, you just look at one thing, the OIC, since we're at an OIC conference, the success of the new box ETF, which is simply a borrowing mechanism that uses the OCC's balance sheet. Like, that credit is credit good that's weathered a lot of different storms. So that has to be protected. Any sort of regulation that comes in, and the elimination of counterparty risk. If you make regulations too stringent in the public markets, all it does, and I can tell you this firsthand, is you just drive it to OTC. When you try to over-regulate stuff, if you are big enough, you can just shrug your shoulders and say, well, I'm not going to play in the public field, I'm just going to go in my backyard. And then you lose regulatory supervision. So that's like a warning to who might have warned regulators. That's a real smart thing to say on tape. I'm warning the regulators. It's something you need to be aware about, that the bigger players can always influence. You talk about Mag 7. Well, we do, in a way, have Mag 7 in the market-making community and options right now, right? There's a few big players out there. How much can they push regulators around? I'm not in that business anymore. I can tell you this, as an asset manager, people will preach that they're looking for new, innovative managers all the time. But talk to any hedge fund manager who's starting out with, $500 million or less. It's really hard to go up against the multi-manager, $59 billion asset managers, because there's security in staying in the pack, right? If everybody's invested in hedge fund X, then if hedge fund X goes belly up, well, we were all in it anyway, there's safety in numbers. So I find that with a small shop, my regulatory bills can be just as high as, absent lobbying, as a lot of the bigger managers, because we have to fill out the same forms, we have the same SEC investigations. And then if you do options on top of that, the lack of understanding, and one last thing is, you look at what happened with Infinity Q, and how much of that was OTC, and how that just went right by the regulators. And then you look at somebody like, Hamilton Ryan or JHQAX. I mean, props to him. He's the biggest options trader in the history of options. he does simple vanilla stuff, and people are always checking into him regulatory-wise. And there's no leverage in his portfolio. I run a similar portfolio, no leverage. It's actually protective. It's a safer asset. We get examined all the time because there's a little bit of understanding. And it gets said all the time, education's paramount in this business. But making sure the regulatory community understands that the proper way of using options. And we stink we need better marketing. We continually blow up, right? The last 10 blow-ups on Wall Street, most of them are somehow options related. A lot of them are OTC. So I'm sorry, I'm hogging the time.
Yeah, no, it's definitely interesting points. And, in my seat at SIFMA, we have a lot of conversations, with the SEC on FINRA. And I think that one of the things that we find is that for a lot of pieces of a broker-dealer's business, the SEC really doesn't understand how their systems work, order routing, which makes it hard when you think about regulation, because if you don't understand the initial market structures and how they're functioning and really how competitive our markets are today, once you start making changes to that, you really risk disrupting things and actually making them much less competitive. Geoff, your firm provides a lot of services to clients, and you have an order management system, execution management, routing solutions, compliance and risk management, post-trade. How do you ensure that TRAFiX products are compliant with the ever-changing regulations? And have you noticed a shift in client behavior due to any of the new regulations?
Sure, yeah, that's a great question. And the first point too, Dennis brought up a really good point too, in that investing space too. If you're an allocator, right, you're not going to lose your job if you're invested in the $59 billion fund that goes under. But if you're in the $500 million fund that doesn't perform well, so I think that there's definitely some inherent selection bias that exists because of that, right? And to your question, Ellen, about the regulatory environment. There's been a continued theme throughout some of the panels that I've been on, and one of them was meeting customers where they are. And TRAFiX, in my opinion, does a really good job of doing that, of collaborating with our customers and understanding what their needs are from a regulatory standpoint. I'll give you a good example of something that we're working on right now that's pretty exciting across the industry is the move toward T+1 settlement at the end of the month on May 28th. So, from our standpoint, our company, we're updating our fixed drop copies and working with clearing partners and doing all of the ones and zeros behind making sure that works successfully for our customer base. But I think what that speaks to more is that we're capable of doing that in this marketplace because of what Jim mentioned, the resiliency of our markets, the depth of our markets, and the technological advances that we have right now. That this is really the first update that the SEC's had for settlement since 2017, as you know. So it's exciting, and I think it brings us more toward overall parity across different asset classes, whether it's stocks, bonds, munis, mutual funds. Now that they're going to be on that T+1 cycle, it brings them to parity with options and govies where they've been for a while. So I think it's an exciting thing for the industry, and it's overall going to be positive. In terms of other regulatory type of things too, we talked about the small, medium, large size shops and how the fees are the same for all of them to handle some complex trade reporting, whether it's CAT reporting or other things like that. That's another thing that TRAFiX does an exceptional job at, and our customers are continually telling us that we consider ourselves an embedded partner with customers to do their CAT reporting on their behalf and things like that, which is it's a great benefit, especially to the smaller shops, right? That they can't afford to have dedicated individuals and resources on their respective trading desks to handle all that. So, we're proud to be able to partner with our clients and help them with that.
And here I am thinking in a panel on elections and volatility, we could go a whole session and not talk about CAT. And I'm totally teasing you. But switching gears, let's spend some time on Bitcoin ETFs and other structured products. Certainly the courts recently cleared the way for Bitcoin ETFs to launch. They've, really soared into the market. There's been really broad adoption of them. But before we can get to Bitcoin or options on Bitcoin ETFs, both the SEC and particularly the CFTC have some work that needs to be done to clear the regulatory approval process for those products. What are your thoughts on Bitcoin ETFs, options, and other structured products, and how do you use those products?
Well, I'll go first because my answer is going to be short because they know it better than I do. But I mean, I think people need to appreciate that we're the only country out there that has like two main regulators in our industry, the CFTC and the SEC. That doesn't exist anywhere else. It tends to be just one regulator in other countries. And these regulators, from time to time, they compete with each other, just like we compete, with our competitors here. The fact that there is this new, options on requires the CFTC to do something, is not. I just don't see them giving this handshake of an agreement or this no action, and allowing this to be regulated by the SEC. So I think there's going to be a turf war on this. I don't see this being going the same route as GLD options on that commodity, and And it's unfortunate. It's unfortunate because obviously the fungibility of options is like the strength of the product, the amount, what it does as far as pricing efficiency and allowing people to express an opinion in a very highly capital efficient way, as opposed to having to buy the underlying or even whatever on it. But I'm not optimistic on these two regulatory agencies getting together and just handing off the oversight on these options to just one agency.
Which is probably a fair opinion to have, because folks may know the applications that the CFT has for both palladium and platinum options have been sitting there since 2012 with no action. So I think that does give folks some reason to pause when it comes to options on Bitcoin ETFs. Want to continue, Geoff?
Sure. Yeah, Bitcoin has been something that's been discussed quite a bit in the panels here, and I think what's interesting about Bitcoin is, if we look at the participation right now in the ETFs that are created for it, right? We look at BlackRock's Bitcoin ETF, IBIT. They went through all their customer orders and they did an analysis on it. And what they found was that the average size of a trade was $13,000. So what that tells me when I look at that data is that it's primarily a retail product right now, right? There's demand out there. So the retail community wants to trade this. I think what we're going to see eventually too, there was just a note out recently from both Wells Fargo and Merrill Lynch that they started to recommend Bitcoin and associated products to their private wealth clients and some of their institutional clients as well. So I think you're seeing a migration toward that, of getting out of the retail space and getting more toward institutional. And some of our customers have expressed interest in those products too. And some of the analysis that you see on how you can fit Bitcoin into an overall portfolio, it's interesting to see, because if you just look at Bitcoin alone, isolated, yes, it's a very volatile product, but when you actually move that into a traditional 60-40 type of portfolio, I think what's interesting is that there isn't really kind of cross-asset correlation in terms of the volatility, so it can actually be a good complement to that traditional portfolio. And what you'll see too in this yield-driven environment that we have, you may actually see folks who are saying, I want to put 5% of my overall portfolio into Bitcoin, because that could enhance returns and maybe give 4 or 5% over that traditional 7.5% or 8% return that you could get. So I think it's going to become a more prevalent type of product. It's going to be more of a household type of thing, and as people get wrap their arms around what the true risk is versus the perceived risk, I think it's gonna continue to be very popular.
We had options on pets.com. Like, trying to tell me that Bitcoin's not more robust than some of the options and internet stocks that we traded. This is ridiculous. This is highly evidence of a turf war where people want to get together. And if you talk to people in the SEC or the CFTC 10 years ago, both were pushing it away. I don't want to deal with it. I don't want to deal with it. And it's rapidly turned into I want it, right? So that's the politics I know, little or nothing about. But on the back of what you said, in talking to institutional people, there's two camps out there. If you're a CIO at an Inventus State pension fund, you're going to have a board. Some of the boards will say, if you touch Bitcoin, you're fired. Some of the other boards will say, we should probably dip our toe in the water. So dipping the toe in the water, I'm talking about like 0.5%, but there's trillions of dollars of assets out there. Bitcoin ETF being listed is the greatest thing ever happened to Bitcoin, in my opinion, because once it's out there and I don't have to, every counterparty is not a potential Lehman, right? It comes into our world, right? And it's no longer guys sitting in gaming chairs with Xbox controllers trading this, right? I remember talking to people saying, you run a hedged Bitcoin fund. Can I see your vol surface? And I don't know anything about Bitcoin, creation, the halvening, and all the kind. I don't know anything. But I know a little bit about volatility surfaces. And I looked at it, there's massive call skew. And I go, well, yeah, this is fantastic. You run a hedged thing, you're getting paid to hedge. You own this downside put, you can finance it with this upside call. Your forward is being priced way higher, so the call is overly inflated on top of that. It's awesome. And I go, let me see your positions. Exact opposite position. And they said the Bitcoin buyer is looking for that accelerated return to the upside. And then Bitcoin sold off 30%, right? So when it comes into our world, there'll be enough people with enough diverging, wisdom of crowds saying, and then people like me saying, oh, state of insert name here, you want 1% Bitcoin? Let's do a hedged Bitcoin. It'll never be down more than 10%, and you're participating up 25%. The guy like, I'll never lose my job, great. That is what I think the future of Bitcoin is. But if I'm trading it on Deribit or some exchange in Malta and my hedge goes poof, overnight, then I got to go back, oh, shucks, looks like you are fired, right? Even though it's 0.5% of your portfolio, you were now invested in the Malta exchange, which is some oligarch or I don't know. Like, it's great that it's there. It is stupid that they don't have options on it because it's making it more risky.
Well, to your point too, I mean, the strategy you were talking about of collaring it, right, selling that call on that put, but there's more of a demand right now, I think, in the marketplace where, and we talked about this yesterday, that there's that positive skew that we see in the marketplace right now too, where folks want to have that upside call, right? They're not interested in the downside anymore. If anything, they want to do the opposite of that trade, and I think that that's a trend that isn't going to really go away, I don't think, anytime soon. I think too, there's a big, user education aspect to this too. That's a big opportunity for the folks in this room. These strategies where if you're short one option, you're long another one, moves down, they end up selling the one that they're long, but then they remain short, and then the thing rips back up. There's issues with that from a retail standpoint of, lack of sophistication and understanding.
Yeah.
So,
well, I'm saying there's lack of sophistication in the institutional side.
Yes,
even there. That's why they need to hire professional managers who are in this room.
Definitely.
And those are some of the concerns as we talk about, short-dated options in single equity names are exactly some of the things, Geoff, that you just mentioned and some of that risk.
Exactly, yeah.
Well, thank you, everyone, for joining us, and that's all we have.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.